It really does. And that urgency, it comes through loud and clear. The quality is high.
It is. But to get this from a great market update to something that really maximizes its impact, we need to shift the focus from just reporting the facts to synthesizing the conviction.
I agree. The core of this rally is clearly the $800 million DOE funding for SMR deployment. Let's dig into that section first.
Okay, so our first high-level opportunity is strengthening the specificity of the catalyst.
The analysis correctly identifies that funding as the ignition point, but the justification for OKLO's huge jump is that it led the charge because it's the high beta, high octane play.
And that's the weakness right there. It's treating that $800 million funding as this general sector-wide benefit.
A rising tide lifts all boats kind of thing.
Exactly. And while that's partly true, it really weakens the justification for OKLO's specific, massive 15% pop. The analysis is relying on the stock's volatility, its high beta nature, not its competitive position.
But isn't that just the reality of these stocks? I mean, they're pre-revenue, high growth. The market sees a big pool of money and the most volatile name just moves the hardest, right?
It is honest, I'll give it that. But it's not truly actionable for an investor. It leaves this crucial gap.
Okay.
Does OKLO have a clear, articulated path to getting a real chunk of this funding? Or is this whole reaction just speculative, based on the nuclear renaissance headline?
I see. So we need to validate why OKLO is a definitive beneficiary, not just the most volatile one.
Precisely. The suggestion is to anchor that volatility to a real competitive advantage.
So, how do we do that? We take the Tesla of nuclear thesis and connect it to something tangible, something tied to the DOE's actual goals?
Yes, we need to connect the company's technology, or maybe its development stage, to what the government wants right now for deploying SMRs. That gives you a concrete competitive rationale.
So we're not just analyzing a stock. We're analyzing a company in a race for a government contract.
Exactly. The report could even propose a brief scenario. Maybe OKLO's reactor model or its regulatory timeline makes it uniquely suited to get a big piece of that $800 million.
And the analysis already mentions the need for 24/7 power for AI data centers. That feels like a critical point.
We should absolutely leverage that, explicitly connect that demand to OKLO's reactor size or its claimed faster path through regulation. You frame it as the best fit solution for the DOE's immediate goals.
Ah, okay.
Then the 15% move is validated. It's because the market sees OKLO has a structural moat around this new funding.
That completely changes the story. Instead of OKLO moved because it's volatile, it becomes OKLO moved because this DOE news validates its business model as the fastest solution for critical needs like AI.
And that is a much, much stronger investment thesis. It's the difference between reporting and true analysis.
Okay, let's pivot to the risks. The analysis is really clear on this massive dichotomy. You've got analysts with targets over $120.
Right.
And yet the company is pre-revenue, it's burning cash, and there's chatter about profit-taking and insider selling.
Which leads us straight to our second point, reconciling that volatility with the long-term fundamentals.
The report lays it out well. You have the impressive bull case from Kantar and UBS, and then it clashes hard with the reality of being pre-revenue, high cash burn.
The weakness here is that by just listing the bull and bear cases side by side, it creates a disconnect. It doesn't give the reader a framework to synthesize them.
It's like, here are the good things, here are the bad things.
Exactly. The volatility and insider selling are presented as just generic risks you'd find in any pre-revenue company. It leaves you wondering, at what point does normal volatility become a real fundamental problem?
That's a fair point. But are we maybe overcomplicating it? I mean, for a company like this, isn't the price of $111 just discounting decades of future growth? How do you even build a fundamental model around that speculation?
That's the very question the analysis has to try and answer. Right now, it risks oversimplifying that valuation challenge. We need to articulate how the market is currently valuing OKLO.
Is the price too frothy, or is this volatility just the price you pay for a ticket to the Tesla of nuclear?
Yes, the report needs to give the reader a clearer framework for handling that volatility.
A valuation framework without revenue, though. That's tricky. How do we do that?
We integrate the concepts of a valuation premium or a risk assessment directly into the discussion. This lets the report explain which price points are fundamental risks and which are just, trading noise.
I like that. Grounding the price action in the actual story. So give me a concrete example. How do we frame a valuation floor without the usual metrics?
We can use that psychological $100 level that's already in the report. But instead of just calling it a battleground for traders, the analysis could argue that $100 represents the critical valuation line.
What do you mean by that?
It's the line where the market has theoretically discounted all the current cash burn, all the regulatory uncertainty, all of it.
So trading above 100 means the market is saying, we believe in the future growth premium.
Break under, say, 90 or 91, well, that fundamentally invalidates the current growth premium.
Why?
Because that price action suggests the market no longer believes the company can survive its nuclear winter phase until commercialization. It doesn't matter if there's $800 million for the sector if the market thinks this company won't make it.
That's a really powerful way to frame it. It turns a simple support level into a conviction line. The reader knows, hold 100, the bull thesis is intact. Lose it, and we have a much bigger problem than just profit-taking.
It elevates the whole discussion beyond simple trading advice.
That's a great transition, actually, because now we have to talk about those trading levels. The material is very precise. It identifies the $100 support, the resistance up at 114.29, and that strong bullish engulfing candle.
The technical precision is definitely there. It's commendable. But our third opportunity is elevating that technical analysis to reflect market conviction.
So the argument is that the technical summary is solid on the data points, but the conclusion feels a bit too mechanical.
Exactly. The weakness is that it ends on a purely tactical note. Watch for a retest of 100 to 105 at the open. If it bounces, the bulls are in control. It's almost generic.
And it doesn't connect back to the catalyst.
It fails to connect that technical movement back to the core fundamental catalyst, the DOE funding, or the shift in analyst sentiment. The levels are important, but the report doesn't explain what they mean in terms of market belief.
Okay, hold on. For anyone who might not be staring at candlestick charts all day, can you quickly explain what that bullish engulfing candle actually signals here?
Of course. Basically, it's a very strong reversal signal. It means that today's price range, from the open to the close, completely swallowed or engulfed the previous day's range.
So the buying pressure was just overwhelming?
So overwhelming it completely erased yesterday's selling pressure and then some. It's a really powerful visual signature that something has fundamentally changed.
Okay, so given that powerful signal, how do we make the analysis reflect that strength?
The suggestion is to frame the movement between these technical zones as validation points for that underlying fundamental story. We need to explain what breaking resistance or losing support psychologically means for the whole nuclear renaissance thesis.
Right. Is the market just reacting to chart levels, or are the levels just reflecting how the market is digesting the big news?
It's the latter, and that's what we need to capture. These moves aren't random noise. They're the market processing new information. So let's take that resistance level, 114.29.
Okay.
We need to frame that as more than just a ceiling.
How so?
We frame it as the definitive point where long-term sellers, the ones who got exhausted during those weeks of bleeding out, as the report puts it, they finally give up. They capitulate. We call it absorbing the overhead supply.
So these are the people who bought higher and have just been waiting for any bounce to get out.
That's them. So breaking 114.29 isn't just a technical breakout. It's structural validation. It proves the DOE funding news was strong enough to absorb all that selling pressure from the old correction.
So it's proof that the new bulls, the ones who bought the catalyst, are stronger than the old, tired sellers.
Exactly right. Breaking that level on high volume would mean the market's perception has structurally changed. It validates the reversal as something more than just a one-day trading spike.
And that gives clear guidance. If we hold above that level, the correction is structurally over.
Precisely. And on the flip side, failing to hold that $100 floor, well, we already framed that as the market pricing in skepticism about OKLO's specific ability to get that DOE funding. That dual interpretation is what elevates this analysis.
That integration is really the key. It gives the reader a complex decision matrix, not just a simple prediction. It's extremely actionable.
And that's the kind of depth you need when you're looking at a company with this much risk, this much reward, and this much volatility.